Good afternoon, and welcome to the Boring Millionaire podcast. My name is James Lamantia, and my mission is to not only make you money with the stock market, but to educate you in a way that you can make money all on your own. So today is Sunday, March 23rd, and I'm excited to recap what we've seen in the market over the past week, as well as to explain that I think that the lows are in, I think that we're ready to see a rally, and now is the perfect time to be investing your money into the stock market. So over the past week, we've actually traded very narrowly across the indexes, being that we have traded flat for the week, both on the NASDAQ as well as the S&P 500. So the reason I see that as almost a good signal is because though we were flat on the indexes, the volatility index continued to decrease over the past week. So what that tells me is that although stocks are not continuing to fall, we're seeing a lot less tension and animosity in the market. So nothing but a positive signal for the market ahead. Then another positive signal that I've been seeing this week is that on Tuesday, we fell over 1% in the morning trading on the S&P 500 as well as the NASDAQ. But through Tuesday into Wednesday afternoon, we actually rallied out of that discount and saw positivity in the market. Same thing actually happened on Friday. Friday morning, we opened down 1%, and then through the day, buyers came in, they bought the value, and we saw the market raise to a positive close for Friday. So I think it is a tremendously great signal that although we're continuing to see some declines and discounts in the market as a whole, as well as all particular stocks, people are coming in and saying these prices are good. I'm eager to buy, I'm enthusiastic to buy, and like I said, that animosity is just disappearing, and there's a lot more optimism in the market over this past week. We might not see it in price appreciation, but we're seeing it in the activity that people are taking across the market. We have been seeing a rebalance. Of course, the market has fallen a little bit, but it's a very, very normal and standard thing to see the market in declines like this. A 10% decline off of an all-time high is actually, by textbook, called a correction. So really, it's doing exactly what it should be doing. It's balancing itself out, it's correcting itself, and with balancing itself out, it actually fell on its one-year average. So I've always said in my podcast that the one-year average is a strong metric to see stocks fall down to. They always balance themselves out because it is an average. However, the market as a whole does the same thing, and in times like this, you'll see it rebalance to its one-year average. The fact that it's a standard decline, fell to its one-year average, went a touch underneath it, it's all very normal stuff, but now we're starting to see signals that the fall is over and the rush upward is about to begin. So I want everybody to be prepared for that rally and not to sit on the sidelines and miss out on it. One piece of information I would like to say that we saw in the market this week was that there was a very good Federal Reserve meeting. The reason I think it was a very good Federal Reserve meeting is because they continued to commit to their plan to continue cutting rates over the course of 2025. So overall, that would be a great thing for the stock market as well as for the economy as a whole. So the fact that they didn't have their meeting this past week and say, yeah, we got to change our mind. We were wrong. The economy is not doing as well as we thought. We actually need to put rates back higher. So the fact that they didn't do that is ultimately a great signal for the stock market as a whole. And I would also like to add, I do think a lot of the selling that we saw over the past few weeks had come from what I like to call panic selling. Panic selling is when people just rush to get out of the market for whatever reason they're inclined to, but it's just quick selling, liquidating, getting right out of it as soon as you can. And that was kind of the motion that I saw with these past few weeks and everything that I've seen in the market. It didn't seem that there was necessarily calculated exits of positions. It was just people getting rid of everything as quickly as they could. I do think that the panic selling was enticed by the new Trump administration. So there are people who feel negatively towards it, and that would give them incentive to get out of the market. But what I would like to say is that if people are exclusively selling to get out of the market ahead of a Trump administration, they would have already done so. I don't think they're going to wait 3, 4, 5, 6 months to get out of something that we're already involved in. If they were trying to just dodge a bullet, for lack of better words, they would have done it already. So I think a lot of the selling did steer from that. I do think all of that emotion from that selling is gone, and we're going to just see a lot of the animosity from that disappear. Like I said, the VIX is down, so statistically speaking, yeah, it is actually starting to disperse, which is nothing but positivity for the market as a whole. I would like to say moving forward, I think that we need to see within this rally, a strong signal for a positive rally ahead of us would be to see the market indexes close above their one-year average. So the one-year average on the S&P 500 500 is 57.52, and the 1-year average on the NASDAQ is 18,445. So if we see a close above those metrics, I'm going to be very, very excited about that. The higher we are above those levels, the more positivity I see around the market and the more incentive I would say other people are going to find in investing in the market ahead. So that's what I'm looking for this week. If we could get at least one, even a second close above those metrics, I would say that we're in good shape and that the rally would have already began and that we're going to see it continue to move higher and closer to that all-time high range. So I think some valuable stocks to look at with this rally ahead would be the Mega 7. A reminder of what the Mega 7 is it's Apple, Amazon, Alphabet, Meta, Microsoft, Nvidia, and Tesla. And the reason I would have a closer eye on these 7 companies is because of their market cap. So they're all trillion-dollar companies. They may be a touch underneath that market cap with the recent market moves, but essentially those are the 7 trillion-dollar companies that we see on the public market. And where I'm getting at with that is if they all move strongly in the same direction, that'll only amplify the stock market's move in that direction. If you have trillions and trillions of dollars appreciating by 2-3% on one trading day, the stock market is going to move at such a greater strength because of that. These companies are just companies within the stock market, but because of their large market cap, they in a way almost dictate how the market moves a little more than, say, a Home Depot or a McDonald's or a Visa. So I would keep a close eye on those 7 companies in the week ahead. If we begin to see a rally across the market as a whole, I would like to see where their part is, what role they're playing, and I do believe that if we get strong rallies out of those 7 companies, the market will be lifted just in a blanket aspect. So I'm very excited and very eager to see how the market as well as those stocks do this week. So another way you could take advantage of the stock market outside of buying those 7 mega companies, you could take $50 and you could break it up into 5 $10 increments and split it up across 5 different companies. So then that way, it's a low budgetary way of getting involved in the stock market. Doesn't take a lot of upfront cost to get involved, and you could split it up between 5 different companies to diversify your portfolio. And then that way you're not putting all your eggs in one basket. You're getting a little piece of the action in all different departments, and then that way that builds a safer, stronger portfolio for you. I would also like to add, putting $10 into a company does not seem like it's very much, does not sound glamorous, does not seem very rewarding, but if you're doing that every week over time, you will build a very strong and fruitful nest egg. And I could say it because I've done it myself. So the proof is in the pudding, and I just want to say if I were to take $50 this week and break it up into 5 different stocks, the first I would buy is actually Apple. It's a top-tier company, it's trading under its 1-year average, and I'm a big believer that when stocks are at their 1-year average or trading below it, it's a huge buy signal for me, and I always like to take an acute look into that when stocks are around there. So Apple is appetizing at these levels. They pay a 0.5% dividend, and we all know Apple well enough to know that they shape the world that we live in. So that's just another point I like to add. You don't have to know the ins and outs of what these companies are doing. You just have to understand that some of them shape the way we live and shape the world that we live in. And to me, that is enough of a proprietary reason to invest in a stock like Apple. The second stock I'm going to pick on this list is MasterCard. So I've always loved MasterCard. I've always loved Visa as well. They trade kind of in tune with one another. However, MasterCard would be the one I'm pulling the trigger on this week. It's trading right at its 6-month average, and I just love seeing it at that metric. I would also like to add that through the past couple weeks, how the market has been declining, Visa and MasterCard had both been bucking the trend. So where the market was down, they did appreciate a little bit. So I think this strength is going to follow through when we see an overall market rally, and I want to be involved in MasterCard. The next one I have on my list is Tesla. Tesla fell very strong over the past few weeks, and with that, it fell under its 1-year average. Again, an important metric to look at when purchasing stocks. But I do think the decline is basically just bad PR, for lack of better words. Of course, there's multiple opinions you could have about what he's doing with the Doge, but ultimately, I don't think anything has changed with Tesla. Yes, there's some vandalism reports going on. They are spray painting the cars, and it's a lot of bad PR as far as what people are saying online, but really, nothing has changed. The space that Tesla is involved in has not changed. The company has not changed. They have not changed their overhead, their finances, anything. The only thing that's changed is their reputation. So as people begin to forget about what's going on in the current news with Tesla, I do believe the stock will recover. And with a previous high of 489, we're basically almost doubling our money with it returning to just its all-time high. So I'm a huge buyer in Tesla in this position that it's in. The next one on my list is Morgan Stanley. Morgan Stanley is one of the leaders in investment banking, and it's presenting a pretty decent discount right now. With the market decline, it did fall to its one-year average, but it's bounced off that since then, but also pays a 3% dividend. So a dividend is income that companies pay you just for ownership of their shares. They're all at different rates. It is what the companies decide to pay their investors. But Morgan Stanley pays a 3% dividend on their stock. Love dividend income. I'm buying it because of that. And then my fifth one is Stryker. So Stryker is the leader in healthcare, tools, equipment, all of that nature. You go into a hospital, you snoop around a little bit, you'll start to see that Stryker has a lot of equipment in there. So not only are they proprietary to the world we live in by making hospitals as functional as they are, it's presenting itself a great buy as an asset itself. It is trading between its 6-month and its 1-year average. So again, I use those metrics, whether it's a 3-month, a 6-month, or a 1-year average. Those averages are where we could usually find stocks trading at. So I always like to look for them. So the fact that it's between its 6-month and 1-year average is exciting to me, as well as it pays a 1% dividend just for ownership of the stock. So you're getting involved in something that shapes the world we live in. It's telling me that it's at a good position to buy based on how the stock is trading, and it actually pays you an income just for owning it. So fantastic buy. All 5 of them are great companies. I've been owning them for years and years and years, and will continue to own them for years and years and years. But right now, they present an opportunity for new investors to establish a good position in them. So I'm always available for any direct questions you would like to ask me. I love helping people understand the stock market, and more importantly, feeling confident in the stock market. So I'm always available to anyone who would want to ask me anything they would want to ask me. Please follow me on Facebook. Please follow me on Instagram, as I always have updates on what's going on in the market, as well as what opportunities are available for us to make money. So thank you for tuning in.